Most people think the goal of estate planning is to have the right documents. That means your will, your power of attorney, corporate structure, insurance. You get those in place and you're covered. But what people don't tell you is documents don't execute themselves. Documents don't make phone calls. Documents don't coordinate with your accountant. Documents don't know that the life insurance that you bought 8 years ago is still in your personal name instead of in your company name. They don't flag that your will references assets that were restructured into some sort of corporation 3 years ago. And those assets don't actually even exist anymore in the way that the will describes. Documents are static and life moves. So the gap between a static document and a dynamic, flexible financial reality is exactly where the estate plan falls apart. Hi, my name is Laurent Munier from Safe Pacific Financial, and today we're going to talk about what actually takes for make a financial plan work, not just exist. And especially you want it to work when the moment arrives that it's supposed to perform. So let's start by giving credit where it's due. The business owners and the incorporated professionals that we work with are not irresponsible people. They're the opposite. They're organized, they're successful, they've thought about their finances more than most Canadians ever will. Most of them have a will. Most of them have some life insurance of some sort. Most of them have some sort of corporate structure. They have an operating company, maybe a holding company, maybe there's a trust. Most of them have an accountant that they've worked with for some amount of years. Most of them have a financial advisor that's managing the investments. And on paper, this is a plan. And in a lot of ways, it's not a bad plan. But the distinction that we want to make is an important one. There is a difference between having the components of a plan and having a plan done that's designed to function under pressure. A will is a document. It tells people what you want to happen when you pass away. But the will doesn't fund anything. It doesn't pay the taxes. It doesn't provide cash liquidity to your family while the estate is being settled and going through probate. It doesn't automatically resolve the questions that arise around corporate assets or retained earnings or your shareholders agreement. What if there's a partner? Life insurance is a financial tool. It pays out a death benefit, but only if the policy is in the right name, if it's owned by the right entity, if it has the right beneficiary designation, and only if you have the right amount of insurance sized to actually cover whatever the liabilities that the estate is going to face. Now you have a corporation. The corporation is a structure. It can provide significant tax advantages, but the corporation at death also creates complexity. You have a deemed disposition. You have your corporate tax obligations. There might be a shareholder buy-sell requirement needed to have been planned for in advance so that it resolves cleanly. The accountant does excellent work, but the accounting is largely backwards looking and it's focused on what happened last year and ensuring compliance. What most plans are missing is not the pieces and components, it's the coordination of the whole thing. It's a forward-looking strategy that has connected all of these components and tested them against scenario where they're supposed to perform. So what happens if you become disabled for 18 months? What happens if you die suddenly and you're 54 years old? What happens if your business partner wants to exit the same year that you have a massive heart attack? Most plans haven't been tested against those types of questions. And the ones that haven't been tested are the ones that create the most chaos for the family when those questions are not hypothetical, but they become real life. So what happens if you actually become disabled? And let's start with something that gets far less attention than it deserves, right? It's not death, but it's actually disability. Because in a lot of ways, long-term disability is more financially disruptive to a business than death. And this happens a lot. Statistically, a Canadian in their 40s is significantly more likely to experience a disability that lasts more than 90 days before 65. And they're more statistically likely to have that happen than die. And that's not a scare tactic. That's like actuarial statistical reality. So for business owners, and specifically the financial consequences of a disability are more complex than there are for the employees. And here's why. When the employee, something happens and they can't work because they became sick or injured, a few things happen. So they have their employment income that stops. If they have some sort of group disability plan through work, some sort of benefit would kick in. Typically, this is somewhere between 60 to 70% of their salary, and it's not ideal, but it's clear. When a business owner becomes disabled, becomes sick or injured and can't work, the situation's a little bit messier The income stops or drops significantly depending on how much the corporation is dependent on you. But the bills don't stop, the mortgage doesn't stop, the staff doesn't stop getting paid, the lease doesn't get stopped, loan payments don't stop, you still have to pay for all your software licenses, you still have to pay for a lot of things. And this is the part that creates chaos. The decisions also don't stop. So the corporation still needs to be managed. The corporate accounts still need to be signed on. The taxes still come due. If you have a business partner, how do you continue the partnership? Does it continue? If you're totally incapacitated, not dead, just you can't work, you can't make decisions, who is able to make those decisions? Who has authority? And this is where most plans reveal the big gap. A personal will only takes effect when you die. It does nothing before. It does nothing during a disability. A personal power of attorney addresses personal decisions and personal finances, and it doesn't automatically extend to your corporate decision-making authority. Unless you have corporate documents like your shareholders agreement and your corporate bylaws that specifically address what happens when a shareholder or a key decision maker becomes incapacitated, the business can end up on the genuine operational paralysis where you're lying in a hospital bed. And we've seen this happen. It's like not theory, this happens. Layered on top of the operational disruption is the financial disruption. If you don't have individual disability insurance that's designed specifically for business owners, you have your own occupation coverage that continues paying regardless if you could technically do some other kind of work, your income replacement during a disability could be significantly less than what you thought it was going to be. Your group benefits plan from a corporate plan, if you have it, typically maxes out after 2 years. So after 2 years, generally, you're on your own. And what does your financial plan look like if your income drops by 70% for 3 years? Most people don't model this. And the answer, when you do model it, is kind of sucks, right? The disability scenario is one that most business owners think is covered, and it's one that most consistently turns out to have meaningful gaps when you actually look closely. Now, what happens if you die unexpectedly? This is not a fun thing to talk about because, and this is the scenario most people think that they have planned for. Also, a lot of gaps and expensive gaps. So I'm going to walk through what actually happens in the period that immediately follows an unexpected death of a business owner. Not like the idealized paper version, but like real life. So the day it happens, shock, obviously. Within days, practical questions start emerging whether the family is ready for those or not. Bank accounts, who can sign? The primary business account is in your name and the corporation signing authority was never updated. So your family and your business may not be able to access your bank account, your corporate bank accounts, while the estate is being settled. That caused a lot of problem in the business. The business itself, you have employees, you have clients, you have contracts, you have obligations. Someone needs to be managing those immediately. And who's that? If you have a business partner, what are their rights and obligations? If you don't have a partner, who steps in to do this work? And you have a shareholders agreement, hopefully, and you should go get it if you don't. Does this clearly address what happens to your shares if you pass away, or to your partner's shares if they pass away? Is there a buy-sell provision? Is there money to fund the buy-sell? Because if your shares in the operating company pass to your spouse through the will, but your spouse doesn't have any skill or interest or ability to run the business, and there's no mechanism for the other partners to buy out the spouse at some sort of fair price or valuation, well, then this situation becomes deeply complicated very quickly. And expectations are different on all sides, right? You also have a tax bill. So in Canada, when you die, this triggers what's called a deemed disposition. So the CRA treats all of your assets as if they were sold at fair market value on the day you died. So for a business owner who has significant corporate holdings, you've got maybe real estate or an investment portfolio, the deemed disposition could be a huge capital gains liability that could be hundreds of thousands or millions of dollars. And that is due by April 30th of the following year. Not sometime down the road and you have years to pay this. This is due now. And if the estate doesn't have liquid cash to pay the bill, and most estates don't, because wealth is usually concentrated in some sort of thing like the business or real estate, or things that take time to sell, then your family is under pressure to sell something to get money to pay taxes, and they got to do it right now in some sort of compressed timeline in a highly stressful situation because you just died. So this can create a forced liquidation under conditions that might not be ideal. Let's talk about your RRSP. If you don't have a spouse to roll it over to, that entire RRSP balance becomes fully taxable income in the year of death. So say you have 800 grand in your RRSP, and this is not unusual for a successful professional. This could be another $300,000 in tax on the final tax bill. And all of this is happening while your family is grieving. They're doing other things. They're making funeral arrangements. They're trying to manage children. They're trying to manage household. They're trying to still go to work. And they're trying to still emotionally keep it all together. So the financial chaos lands on top of personal chaos. And then this is the part that really gets me, right? Almost all of this is preventable. Obviously not the grief, not the loss, but the chaos, the forced selling of your real estate, the forced selling of the business, doing everything right now because the tax man is calling, the tax bill that arrives and there's no money to pay it. All of this is a planning problem. And planning problem, unlike a lot of other things, could be solvable if you do it in advance. So, getting sick or injured and not being able to work, we call it disability insurance. This creates chaos. Unexpectedly dying at the wrong time creates chaos. Most business owners have taken some sort of steps to have a plan. They have wills, they have insurance, their corporate structure, but this plan fail under pressure. And in our experience, it almost comes down to three things. And once you see them, you can't unsee them. So one of those things is documentation. So your legal documents, your will, power of attorney, representation agreement, your corporate shareholder agreement. This reflects your life as it was when these pieces of paper were created. Ideally, they've been updated, but most of the time they've not. And so for most business owners, like I was saying, they were drafted when the corporation was set up, or when they bought a house, or when they had a child. And for a lot of people, this is 5 or 10 or 15 or 20 years ago. And since then, the corporation might be restructured. There might be a holding company. You might have bought real estate, or you might have sold real estate. Your family situation might have changed. You might have an old wife and a new wife, or an old husband and a new husband. You might have your kids and stepkids. There's a lot of moving parts here. Your value of your business might have changed. But the documents sat in a drawer for 10 years and nobody's looked at them. So when the estate gets settled, the executor is working from the will document and the other documents that describe a financial situation from 10 or 15 or 20 years ago. And that financial situation doesn't exist anymore, right? The assets that it talks about in the will are different. The beneficiary designations on your insurance policies or your RRSP, they might be for people that are no longer in the picture or outdated, or you want to update them. Maybe your kids were minors and now they're adults and you want to change your beneficiaries. So this document gap is really the gap between what the legal paperwork says and what the financial reality is at the time that something happens. If you're a business owner and you have active, evolving financial structure, the gap is larger than anybody realizes until you test it or until the thing happens. So the other problem, and we'll call this another gap, is funding. This is the most expensive. So the plan can be legally perfect, all the right documents, the right structures, the right intentions, and it still fails catastrophically because there's no money at the moment that the plan needs to execute. So your tax bill is real, but you got no cash. The buy-sell agreement requires the partners to purchase your shares, but the life insurance that was supposed to pay for all of that was never put into place. Or you set it up 10 years ago when your business was worth significantly less, and now your business is worth significantly more, so you have the wrong amount of insurance. Or the insurance was structured incorrectly. So the estate will need time to settle properly, but the family needs money now. Liquidity at the right moment is what makes the plan functional instead of theoretical and on paper. And for a lot of business owners, this liquidity piece, where does the money actually come from to pay for all these things, has never clearly and properly been answered or set up. So insurance when you structure it correctly, is almost always the answer to the funding gap. Not because it's the only option, because it is one thing that can deliver a precise, guaranteed, predetermined amount of money at exactly the moment that it's needed, without depending on market conditions or selling assets or timing. But only if you set it up right. Only if it's structured correctly. Only if it's owned by the right entity and designated to the right beneficiaries. Right? Your insurance policy that you bought 12 years ago for a different purpose, in a different structure, at a different stage of your life, that might not be solving this funding gap. It might just be creating the appearance that I'm kind of okay, but really I'm not. The third thing is the execution. So this is one that surprises people because, it's not about documents, it's not about money, it's about people. So who actually knows enough about your full financial picture to execute the plan when you're not there? So your will name an executor, but does the executor know where all the corporate documents are? Do they know the name of your accountant? Do they know about the holding company? Do they know there's a shareholders agreement that needs to be triggered? The power of attorney might authorize them to make some decisions, but do they understand the corporate structure well enough to make good decisions? Do they know who to call? So your accountant will know your tax situation, say, but do they know your full insurance picture? Do they know what's in the will? So this execution problem is the gap between what the plan says is supposed to happen and what the people that are actually supposed to execute it actually know how to do. And this is usually the biggest gap of all, because even if all the documents are right and the funding and the money is there, if the right people don't know the right things at the right time, the execution falls apart. Life insurance isn't just protection. It's cash liquidity at the exact moment that you need it, and usually at the worst time. And so we'll spend a little bit of real time on this because it is one of the most misunderstood aspects of the estate and contingency planning for business owners. Life insurance is almost universally described as protection. And it's protection. But if you're an incorporated Canadian business owner and you have a complex financial structure, the more precise way to understand it is this. So you say, life insurance is pre-funded, pre-positioned cash liquidity that arrives at the exact moment that your plan needs money the most. Big sentence. Let's break it apart. So when you die, a series of financial obligations become immediately or very quickly due. So number one is taxes. Then you have the buy-sell agreement. The income that your family needs to settle the estate. You have the corporate obligations that need to be funded. These obligations are not going to wait for a favorable real estate market. They're not going to wait for your investment portfolio to recover from a drop. They don't wait for your executor to sort through, thousands of papers. All of these things arrive, and they arrive right now, right? The only financial tool that delivers a very specific, predetermined amount of money at exactly that time, regardless of what the market is doing, is life insurance. It's not your real estate. That's slow. It's not the investment portfolio. That goes up and down, right? It might be down in the year you need it. It's not your corporate retained earnings. Those are their own tax problem when you need to take them out of the corporation. It's life insurance. And here's the part that most people get wrong, right? The insurance has to be the right amount of insurance and has to be structured to match the actual obligation. So if your capital gains bill on death is $600,000, the insurance needs to be that, right? The $500,000 policy you bought when your estate was smaller is still good, but it's not going to cover the 600 grand. Keep the 500. It's better than zero, but it's not covering 600. If your shareholders agreement requires you to buy, or your estate to buy out your partner for $1.2 million, the insurance needs to be $1.2 million, not 800 grand, because that's what was comfortable when the policy was set up 15 years ago. If your family needs 18 months of income while the estate settles, that income needs to come from somewhere. And ideally, you have an insurance policy that was designed and set up to pay for that, right? So this funding gap that we've described in the previous section is almost always dependent on kind of how big is your insurance and where is your insurance? How is it structured? And it's almost always kind of like in the same way. Well, the insurance will get put in place at some point in time, usually when somebody is doing all these things at the beginning. So when you're incorporating the company, when you're having your first home, a first child, the coverage amounts are adequate at that time. But now years have passed. So the business is bigger. Your real estate is worth more. Your corporate holdings are bigger. Your portfolio is bigger. Your estate gets more complex. But you've kept these same insurance policies the whole time. And now the gap between what your actual today financial obligation is on death and the insurance coverage that you set up 5 or 10 or 15 years ago, these are different. And this gap gets bigger and bigger. And nobody really flags that, right? Until the worst time, and now the insurance needs to do what it was supposed to do. And that's when everybody discovers that the plan doesn't have the money that they thought it had. So the other structural issue that we see is that the insurance exists, but it's got the wrong ownership. So a policy owned personally that should be owned in the corporation is missing the opportunity to fund a capital dividend account, which would create a tax-free distribution to the shareholders. This helps get the retained earnings out of the corporation to your family. The policy that's owned corporately, but should be owned personally, creates tax complications for whoever is the beneficiary or whoever you wanted the money to go to. A policy with beneficiary designations that no longer match the estate plan because the estate plan was updated, but the insurance was not. So maybe, you have the blended family. Somebody got divorced and then remarried, but maybe the old spouse is still the beneficiaries, or maybe now there's new kids in the picture, right? And so how do you divide all this? And how do you update all those beneficiaries? These are not theoretical problems. These are very, very serious problems when they happen. And they're the kind of problems that surface when you have a detailed insurance review, which is what we do with business owners or with all of our clients who've had their policies for some time. So getting the insurance right means a few things. So number one, you need the right amount. And that needs to be matched to the actual financial obligations that you think the estate is going to face sometime in the future. You need the right structure. So the insurance needs to be owned by the right entity. You need the right ownership, right? And it needs to be designated correctly, and it needs to be integrated with your corporate tax plan. So you want to review and update your financial picture. You want to update your insurance as it evolves. So when these kind of three things are in place, the insurance isn't really just a product that you bought and left. It becomes what it's supposed to be, which is an engineered cash liquidity tool that makes everything else in the plan work at the worst possible time when you need it the most. Well, actually, you don't need it, you're gone, but when your estate and family need it the most. So having the right structure reduces the chaos. It doesn't just reduce tax, right? And this is a point that I think gets underemphasized in most financial planning conversations. When you talk about the corporate structure, you talk about the holding company, your shareholders agreement, your estate freeze, maybe there's a family trust. The conversation is usually around tax efficiency. And that's where most professionals, the certified financial planners or your accountant will take it. And tax efficiency is real and it's important. But the structure does something else that matters just as much when life doesn't go according to your brilliant plan. The structure reduces the chaos that we've been talking about. And let me show you what I mean with a very easy comparison. So you have person A, operating company, holding company. The holding company owns the retained earnings and the investment assets. There's a shareholders agreement with a clearly funded buy-sell provision to the other shareholder. The will is updated and it references the correct current corporate structure. The insurance is owned by the holding company and it's the right amount of insurance to cover what we estimate is going to be an estate tax liability in the future. And the beneficiary designations are set up correctly to flow through the capital dividend account. The accountant, lawyer, financial advisor have all seen the full picture sometime in the last 18 months. There's a document, sometimes called a family emergency binder, that outlines where everything is and who to call for each of these things. This other one, business owner, the other one, has a single operating company with significant retained earnings, no holding company, no shareholders agreement, an 8-year-old will, life insurance in their personal name that they bought sometime when they got their mortgage more than a decade ago. They have an accountant who manages the taxes. They have a financial advisor who manages the RRSP. and they have a lawyer that they haven't spoken to since they got their will drafted 8 years ago. Nothing's written down about what should happen if something goes wrong. Both of these people have assets. Both of them have some planning in place. Both of them would probably tell you that they're reasonably set up. But when the unexpected happens, and it's going to, the experience for their family is totally different. First owner, their family has clarity. They know who to call. The executor has a document that explains the corporate structure. The insurance pays out within a couple of weeks, which gives them cash to deal with a bunch of stuff. The shareholders' agreement activates cleanly. The tax bill is funded. The estate settles in a predictable, manageable way and is not chaos for the family. The other business owner, chaos. Nobody knows the full picture. The estate takes 18 to 36 months to settle because the corporate structure wasn't set up properly in the will. The insurance is in their personal name. There's a tax consequence that nobody planned for. The retained earnings in the operating company are not accessible because the whole estate is now in probate. And then you have a forced sale of the business assets, usually at a discount because you need to pay the tax bill, and there was no other money to pay this tax bill. So same wealth, same general intention, completely different outcomes. And the difference isn't like their assets. It's not how much money they had. It's the planning and the structure around this. And this is where we push back a little bit when business owners tell me that their structure is always about tax. Tax is important, but that's not it. It's resilience. It's clarity. It's about, what does your family and business actually look like on the other side of this terrible event that's probably going to happen? It's whether the structure that you've built is designed to protect your family, or does it cause massive complications in their lives? The good structure answers all of these questions before they get asked. It takes away the ambiguity. It pre-solves problems that we know are going to come. It pre-solves problems that are going to be expensive. It pre-solves problems that are going to take a ton of time. It pre-solves problems that are going to cause a lot of emotional hardship to the people that actually have to manage those problems on the other side. And that's why you want to have the right structure. So we kind of call this like the quarterback, right? And here's how most financial planning relationships work. You have your accountant, which is the tax guy, compliance. They do your year-end planning, and they know your numbers better than most of other people. You have your lawyer who drafted the will, maybe your corporate documents, they incorporated you, maybe they did a little bit of a shareholders agreement, or you had a property or something like that. And then if there's a legal task, they do it. And then you have your financial advisor who's managing the investments, and they're doing a good job too, right? They understand your risk tolerance, they understand your portfolio objectives. And then you'll have your insurance advisor who sold you some coverage at some point and checks in maybe once a year, hopefully. So you've got 4 different professionals, all competent, all doing their specific job well. But the problem is none of them own the full picture. None of them are accountable for making sure the whole thing is coherent. The accountant doesn't know the exact insurance coverage you have, or whether it's structured correctly in the corporation or personal to solve the estate liability. The lawyer doesn't know whether the corporate structure that they set up 3 years ago has been updated to reflect changes in your financial situation. The financial advisor doesn't know whether the investment strategy that you have inside the holding company is creating a passive income problem that's eroding your small business deduction. And your insurance advisor doesn't know whether the beneficiary designations that we set up on your policy 8 years ago still match the estate plan. Nobody's sitting in the middle. There's no quarterback. Nobody is accountable for making sure all of these things connect and that all these people talk to each other and know what's going on. And this is what I mean when we talk about the quarterback, right? This isn't somebody who replaces these other ones. These people all play a critical role on your team, and they all have the deep experience and the expertise in their area, but you need somebody in the middle who understands the whole picture, the corporate structure, the tax position, the insurance plan, the estate plan, the investment plan, and whose job it is to make sure that all of these pieces work together. The quarterback needs to ask the questions that cross these boundaries. Does the insurance coverage match the estate liability? Does the will reflect the current corporate structure? Is the investment strategy creating a passive income problem? Does the shareholders agreement have an updated and funded buy-sell provision? Right? If something happens tomorrow, does anyone other than you know enough about this plan to actually execute? So these questions don't belong to any single one of these professionals. They belong to whoever is looking at the whole picture. And that's really the role that we like to play at Safe Pacific. I'm not your accountant, I'm not your lawyer, and I'm not trying to be. Both of those relationships are essential, and we work with your accountant and your lawyer. And if you don't have one, we can introduce you to good ones. But we're in the middle. We want to make sure that the whole strategy is coherent, not just the individual pieces make sense for the individual silo. And we want to be the ones, well, we don't want to be, but we end up being the ones that ask and push back on these uncomfortable questions before you have to, because you want to ask these questions before you must, because when you must, it's too late. And what does this look like? What does the coordinated plan look like? And it needs to be concrete, because really it's easy to talk about coordination and this abstract terms. It's harder to understand what does it actually look like when it's done properly. And now here's what a genuinely coordinated plan covers if you're an incorporated Canadian business owner that's successful and making good money. Your will needs to be up to date and current, not 8 years ago, current. It reflects the current actual corporate structure. It names the right executor. It has been reviewed sometime in the last couple of years. If any significant changes have happened, it's updated. So any business changes, any personal changes, you bought a house, you sold a business, your kids are no longer minors, they're adults, right? Does it reflect your full personal, financial, and business picture? Now, your power of attorney, it covers corporate decision-making. Does it? I don't know. Does your power of attorney just cover you personally? The corporate documents specify who has decision-making authority, who can sign on the bank account, what are they authorized to do, can they pay your staff, what happens to the business operations, can somebody sell the company, right? If you, as the primary decision-maker, are gone, who takes that over, and is that reflected in the power of attorney? Then you have a shareholders agreement if you've got other shareholders in your business. Is it active? Is it correct? Is it up to date? And is there a funding mechanism? So if you have multiple shareholders, the agreement addresses what happens if one of them dies, or one of them becomes sick and injured and can't work, or one of them wants to leave, or one of them gets divorced. And what is the mechanism for executing the agreement? The buy-sell part of it. Is there money to fund that? So typically, the buy-sell part gets funded through some sort of life insurance or a disability insurance or critical illness insurance, and ideally through all three. And the insurance amounts are the correct amounts to fund your business at what your business is worth now. Not I set up insurance 10 years ago when my business was a startup and worth not a lot, and now it's worth millions. Well, the insurance you set up 10 years ago is going to be way too small. It's better than zero. So do that. Even if you have the wrong amount, it's better than not having any, but you definitely want to update it and make sure that it's the right amount. Your insurance should be current. It should be correctly structured and held in the right place. Is it corporate? Is it personal? And it should be the right amount to whatever you think the business is going to be worth. So this means that somebody has actually gone and modeled out, what does this estate tax look like today? Not when the insurance policy was bought years ago. It means the ownership and the beneficiary structure has been reviewed and optimized relative to your situation today. It means the coverage is integrated with your capital dividend account, your CDA, so that it can maximize the tax efficiency when the money from your corporation ultimately goes to your family, right? Your investment strategy should account for passive income rules. These can get really expensive if you don't do them right. So the corporate investment portfolio needs to be managed with the awareness of this $50,000 threshold. And what does that threshold impact on your small business deduction if you qualify for it? So you can have tools, say a participating whole life insurance policy, that when you used it appropriately, it can build up your corporate wealth inside the corporation, and it can serve as part of your corporate investments without triggering this passive income grind. But then it also provides estate liquidity because it's life insurance. So one day when you pass away, it's going to pay out, and it's going to create money to pay for all this stuff. So it's not just assets, liquid assets, right? You might have real estate, but can you sell it and get money from it? You need the mechanism to create this liquidity quickly. You need something to fund the tax obligation on death without forcing or rushing selling off assets. And this is almost always addressed through insurance, sometimes through other like liquidity structures, and that's fine. But critically, you need some sort of document that makes all of this work. You need a clear record of what exists, where is it, who do you call, what to do, what not to do. And you don't want this in somebody's head. This needs to be written down so anybody can read it. And because you're probably not going to be here, so you're not going to be able to explain. You need this piece of paper or this book to explain everything to do. It needs to be updated. It needs to be updated regularly, right? More than just once. And it needs to be accessible to the people that need to act on it, right? And this doesn't have to be complicated. And you can actually probably use some AI, ChatGPT or Claude or something to help you put this thing together. But in practice, getting all of these elements in place and coordinated with each other and kept current over time, that's the work that you need to do. And it's the work that most business owners generally don't do or are going to do one day but haven't got to it. And it's not because they don't care. It's because nobody's shown the urgency or organized it in such a way that hey, we're doing this now. And so the honest conversation, that we want to be direct about is, the reason this conversation doesn't happen more often is because advisors don't know about the risks. Most experienced advisors are aware of, the document gap or the cash liquidity funding gap or the execution gap. But it's because this conversation requires uncomfortable questions. Have you actually tested your plan against what happens if you die tomorrow? Does your executor actually know enough to do this? You might have picked your brother or your sister or your cousin to do this. Are they smart enough? Do they know what to do? Have they ever done this before? Probably not. Do they live here or are they in some other country and now this is a huge problem? Is your insurance actually the right amount of insurance to cover what we estimate is going to be your estate tax on death? So these questions make people uncomfortable because we're talking about death and we're talking about bad things that could happen. It forces a confrontation. It forces people to think about scenarios that they generally prefer not to think about. And they're hard to ask when things are going well. Because when your income is strong, your business is doing great, future looks bright, the urgency to stress test there's no urgency, right? Everything's fine. I don't need to do that right now. But here is what we've learned after doing this for years. The ones who are most grateful, the ones who tell me that this was the most valuable part of the plan that they ever did, they almost never had this conversation after something went wrong. They had this conversation when everything was fine, when they had time to think about it, when they could get it done not in a rush, when they could do it on their own time, right? They had options, when doing all of this was inexpensive and relatively straightforward. The ones who had the conversations after something went wrong, after the health event, they had a heart attack or something like that, after a big partner dispute, after a divorce, after an unexpected death, they were managing damage instead of building, right? And then the damage is always way more expensive than the prevention, right? Trying to do these things after, A, sometimes you can't because it's done. And B, it's going to be more expensive. It's going to be more stressful, more chaotic. And we're not trying to create fear here, genuinely not, but it's just trying to create some urgency because these are all solvable problems, right? And they're so much easier to solve when you do it on your term, on your time, and not under pressure, right? So most business owners don't have this planning problem. They have this execution problem. They have all these components mostly kind of in place. They have a will, they have some insurance, they have a corporation, they have the intent to do all this kind of stuff, but the pieces aren't connected. They haven't been updated. They haven't been tested against real world scenarios. The funding isn't guaranteed. The execution gap hasn't been addressed. Who is going to do all of this? And the documents from 8 years ago and 15 years ago and 4 years ago were great at that time and probably made sense. But today, your financial situation has changed from 8 years ago. So we need to update all these things. And then the result is a plan, when you don't do it, is a plan that looks solid until you actually need it. And you're not there to fix it because you just died. So now everybody else needs to fix it, and they don't know what was in your head. So really what separates this plan to make it perform from one that falls apart and creates headaches and chaos and family dysfunction and disunity is coordination. It's somebody who looked at the whole picture, who connected all the pieces, who said, what if this happens? What if this bad thing happens? All right, yeah, everything's going to be fine, unicorns and rainbows, but what if bad things happens? Let's find the right person to actually be executing on all this, to call the accountant, to call the lawyer, to call all the people, right? How do we make sure the insurance is the right amount of insurance and that it's put in the right place? It's got the right beneficiaries, right? 10 years ago, the insurance you set up was great, but your situation today is different. Does that need to get updated? Does your corporate structure need to get updated? Is your shareholders agreement updated? And is it going to work the way you think it's going to work when you need it to? And is there a quarterback in the middle making sure that all of these things are coordinated as your life and your business continue to evolve? And this is what we do at Safe Pacific. Like, we are good quarterbacks and we like to be the quarterback. So if this is you, if you're a business owner, if you're incorporated, if you're a high-income professional in Canada, and you want an honest assessment of whether your plan will actually work, if something happens to you tomorrow, well, that's what we do, right? Then you can set up a discovery call with us so that we can go over your current situation. We can look at all these things. We can talk about your goals and your concerns moving forward, and we'll walk through the full picture. We'll look at the documents, the funding, the structure, the execution, and we'll push back and ask the uncomfortable questions that a lot of people don't want to bring up and that a lot of people can't bring up just because they're not emotionally or maturely there. And we'll tell you clearly where you stand. If anything's missing, if you're good, we'll tell you you're good, right? There's no pressure. There's no rush on this. We just want to make sure that you're good, right? You can book in our calendar through the website. It's at safepacific.com. There's a lot of links to our calendar on there, or you could just send us a message through the contact page on there. Those messages will come to me. Somebody on the team will reply to you within 24 hours to set up a time. Today's video was a little bit tougher, a little bit harder conversations to have, and it might affect you, but it would also affect all of the people around you, right? So maybe your parents are still here. You should have this same conversation with your parents, because did your parents write a will 15 years ago? Is that up to date? Did they sell the house? Are there grandkids now that weren't there when the will was written? Like, a lot of things have changed. You also want to set it up for your spouse, right? Does your spouse have all of this stuff? Because if something happens to them, all the problems I just talked about become your problems, right? So you want to make sure that that's clean. So again, like I said, this video is getting really long. Contact us through the website, safepacific.com, book a time in our calendar, and we'll make sure that you get sorted out. We'll be your quarterback. That's it for me. Thanks for watching. I'll see you on the next one.